to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Tonight's video, we're just going to discuss all of a sudden the markets have gotten really quiet. Volatility has calmed down. So we're going to carry this forward and see what is around the corner. Let's go. All right, folks, sorry for being a few minutes late. Had some issues going on in the studios, but we're all up and running now. So as we kind of look at what's going on in the markets, it's interesting. You know, Trump got this amazing reception in Saudi Arabia, now on to Qatar and on to Abu Dhabi and the whole bit, right? We're just seeing him accumulate more capital investments. And I think one of the things that I want to talk about tonight is really what this really means. Right now, Trump has all the power in the world, not just because he's the U.S. president, but think about this. And I don't know what the numbers actually are. They're all over the place. You know, Trump usually inflates things a little bit, but there's somewhere between 3 and 8, maybe more trillion dollars of capital investments that he's managed to at least got promises for, right? They're handshakes. Whether these come to be reality or not, we'll see. I suspect they're capable, but think about what he's got. He's got way more power than Jerome Powell or the Federal Reserve. Everybody's worried about what the Fed is going to do. Who cares? The Fed has no effect on at least what's going on at the moment. And the reason why I say this is if we look at what Trump's got, he's got capital investments, not just money. So if the Fed goes out and does QE and again and floods the market with money, that goes in the economy, and the economy theoretically will use up that capital, and money will cost of money will go down and all that, and that expands things. But what if you have actual folks willing to make capital investments in AI and in the future of the planet, and they're willing to do them here, right? And that's what we're seeing. And, you know, it's like all of a sudden, I think the reason why the markets are quiet, because no one wants to make a move and get caught in this crazy volatility we've seen. You know, we've seen, 3 and 4% moves often, throughout this cycle the last month. And, the day of the announcement of the tariffs, I mean, that was, like 11% range. So no one wants to deal with that volatility. We've seen liquidity dry up. We've seen everything. So all of a sudden, markets got really quiet. It was interesting because when we opened tonight, I was watching everything was just very narrow range. We've opened it up a little bit. We're down 10 and a quarter right now on the S&P, but we were down about, I think, 15, 17. So we've recovered a little bit, but the range has expanded overnight, but it was like literally a 3 or 4 handle move there for the better part of the first hour of the reopening. But the capital investments that are laying out there right now are intense. So let's think about how they could be used. I was thinking about this, excuse me, earlier, and the result of what could happen. Let's say the economy starts to slow down. You make a phone call. You already got the pocket trade, and you say, "Hey, are you guys ready to move forward with this announcement and go with X, new AI facility, whatever it is?" And all of a sudden there's capital investment coming in, and it could be trillions of dollars. You do multiple deals at once. All of a sudden cash flow, employment is being, unemployment's being dropped, and you got jobs and you got capital and cash flow. And then it's also beneficial, obviously, to the international partner, right? So they're going to get cash flow from their business. The workers are going to get paid. That money flows into the economy, and everything's wonderful. So you have a much better tool to avoid some of the recession. I'm still in the recession camp in Q3 and 4. I still I don't know if we'll call it a recession, but I see some negative numbers coming. Whether we can get consecutive quarters and get the technical definition of a recession or not, we'll have to see how that plays out. But this ability, or not the ability, but having these capital investments in hand, if you think about it, way more important than the Fed adding $3 trillion of money into the market, which is going to be ultimately inflationary and so forth. If you bring in capital investments, then that's going to be probably deflationary from the standpoint that you're going to have the cash flow, but you're not going to have the so-called stimulus in the way of just dollars coming in. So I think this is a unique way to look at things. And, so going forward, that's going to be I want to call it the trump card, and it is the trump card that they can play if things start to look a little sketchy. So I think this is a pretty amazing setup. If we were just running a business right now and we knew we had these access to these monies, whatever that would give us the ability which to build our facility out or our company out or whatever it is, I mean, we're in pretty good shape as a company. So you equate that to the U.S. economy, to the world economy, it's pretty interesting. I think the other thing that we're seeing, at least from the Arab world right now, they'd rather do big investments. You don't see them doing investments in China. They would rather do investments here in the U.S., have the free flow of assets. There's rumors we're going to get this, new tax bill to come out. We'll see. They're still playing games with it. It's Congress. They're going to have to kind of work through a lot of issues. But the bottom line is we're seeing the basis for the future, and that's probably more powerful than anything. So let's talk a little bit about the market configuration here. And I still think I titled this video tonight that, the market's about to stall. I think they're a little tired here, and it's pretty typical. If we go back several weeks ago, I've been arguing that we're probably not going to see an all-time new high out of this pattern, but now we've hit this range. We're still trading a bit above the 200-day moving average on these indices, at least on the S&P and the NASDAQ. So that is going to be, I think, positive. That's creating a little bit of a positive sentiment, but we could start to dip under, and depending on what comes out or doesn't come out of this, we could see a little more downside volatility as we go forward. And it's interesting to see, like all rallies, you just kind of get to this place. One of my old mentors, and I was thinking about this earlier, I was watching the market. It was a very quiet trading range. And he used to always say this was a corn pit trader in 1979. But still, he always used to say, never sell. You never go short or never sell a quiet market. And so that's kind of ringing in the back of my ears, even though that was quite a few decades ago, those old cliches and some of those old school guys that were around. This guy was been gone for a long time, probably 30 years, but it was the wisdom of that old market action. That was when we were not in the digital world. And the digital world's a bit different, but some are still people. We could see these things physically in the trading pits, and it still exists because it's, when markets are quiet, that lion can roar or come in. So typically, I think what the whole inference of that is that, when markets are quiet, especially after an uptrend, be careful getting short here. So I'm going to stay cautious. I've got the sheet run out when we go through the S&P here shortly. I've already run a sheet, and everything's still bullish on the sheet. So we still have upward bias across the board. So it's very difficult to try to get negative here. But stalling and negative is two different things, where we get more consolidation. Basically, the data sheets are saying that we're in a consolidation phase, and that's likely to continue until we burn off some of this overdone momentum that we had. So there's still that going on. I've looked at the data sheet, data WaveTech database, and it's been run and updated, and nothing earth-shocking, but it is starting to show some rotation as well. I'm just looking at my notes here, just making sure that I can I've covered all the basics. But yeah, I think in summary here, as we look at what's going on from a sentiment standpoint, is underlying sentiment still bullish. Trump's out of the country yet. Is the meeting? I haven't looked to see, but I haven't heard anything that I'm aware of. Is the meeting with Putin and Zelensky? I guess Putin's not going to show up, but I think they're sending somebody else to talk. We'll see if there's any movement there with the Ukraine situation. And then, Trump's still out of the country, so I think, like I said, I think everybody's just being really cautious. It's pretty easy to get caught and burned, especially if you're a day trader or something. I'm going to attempt to do something tonight when we get to the S&P. I was working with somebody last night after the broadcast, and it's kind of interesting. I always run the daily analysis. I'm going to run like a 4-hour chart on the S&P, and we'll run a fact sheet on that as well. So let's go ahead and get into the database here. So interesting enough, we're still just dropping a little bit here. We're at 68% bullish right now. We've got a little bit of a negative run going where we had about roughly 210 exits. I'm sorry, new entries, and 637 exits. So we have a slight negative rotation. You see sentiment's negative here on the ratios, but nothing material. We're still at 68.43. So those of you who've been around the channel for a while, the numbers that we're always watching is 68.72 is kind of where we're getting a little frothy, where we're getting a bit overdone. And then on the downside, 62 to 58 is the next where we could pull back from a percent basis. And typically what we're going to see here, and you can see it here, the new buys are less than the sell. So we're getting a bit of a negative rotation. Eventually, as this thing washes out, we should probably hold 62.58. And then at that point, we'll see what the technicals look like and see if the momentum is shifting to more of a liquidation. And, we could see that rotation. I've talked about this before, just to mention it. When we go through like an intermediate right now, let me bring this up here. So if we look at the weekly configuration, is we're 29% bullish on the intermediate, and so that needs to get over 42 to get some traction, to give us some. If we get over 42, then I am going to be talking about all-time new highs, more of a sustainable from an intermediate standpoint. But right now we're still neutral. This thing could go up to 32, 33, and then fall back in and just stay above the 22 number, which is the minimum. If we go under 22, then we get back into a liquidation on the intermediate. I don't see that happening, but I do expect to see this churning in this range here. So we'll just have to pay attention. We stay above this in the 68, 66 handle for a second week. Then what we'd like on the daily, we're likely to see some positive rotation when we come into Friday. The intermediate models are run after the close on Friday. They're basically running on weekly charts. And so we'll get that on Sunday night's video. I'll talk about what's going on with the database, and I'll probably zero in. We've got 2 more Substacks going, so that will put us into Friday. and we'll see what kind of market action we get and see if I can come up with some kind of estimate. I usually try to come up with an estimate of what we're likely to see from the intermediate models. But right now, this is pretty typical recovery type situation where we went from literally 10% long to now we went up above 70%, and now we're backing and churning here. And this is pretty normal type activity around the market. So it's a bit different. I know a lot of folks, they just look at the S&P and talk about metrics there. I'm fortunate to have the view to look at 14,660 individual items and watch the rotation. I've been watching this rotation. This is software I built back in the 1990s, and so I've been watching this for decades. And I know how normally things flow, and when we're into sustainable trends, and that goes back to why I was bullish in 23, and in 24 when we came in, I was telling you that we're going to see, back-to-back double-digit years. A lot of people didn't believe me, but that's what happened. Now we have to work off. I'm still on this scenario, folks. Is we have to work off this. It's not really an overbought, but we need to consolidate those gains so that I've been preaching about this when we're looking at the charts on the on the volatility on market grid, where I'm talking about getting a volatility bubble, then normalizing, and then that's where the next move comes from. Same thing with this database. It blows up. We get to 70%. We need to come back in, consolidate those gains, and then get another surge up. And typically, the next couple surges, this surge that we went up to around 72%, will be probably the high water mark. And then the next surge, if we come down to 58, 62, next surge we get up to 68, and then we rotate a bit more, and this cycle kind of consolidates and normalizes. And meanwhile, this is a short-term database I'm talking about. Meanwhile, when we look at the intermediate, then we see this same larger scale happening there. And intermediate's very finicky when we get into these rotations, because we got into deep selling going on during the sell-off down to 21%. And we have, I've got it up here now, we're 29%. I'll zoom in so you can see this. But we're at 29%. And that's not 42, and it's not even 32. So once we get over, it's 28 to 32% is where the consolidation phase will happen. If we don't get over 32, we could see basically a reversion back to the mean, which would be around the 22, 28 range. So we've got a lot of work to do, and this has been my argument all along. Not so much that, we weren't going to rally, but this is from a sustainable trend. We're not there. No matter what, in my opening comments, no matter what I'm talking about here from the standpoint of what Trump's got in his pocket with these big capital investment deals, that is for 26, 27. That's where those cards are going to be played, I would predict. So I would not go through the scenario that's going to be thrown out. Maybe there's some big deal with a AI center or something. Who knows what type of announcements? And they're going to be looking to pump the markets. Now, we watched, going back in the last 4 years, we watched the Biden administration pump the markets through immigration and basically cooking the books on just about everything, and including throwing the cash. When I was talking earlier, they were just, do the infrastructure deal, throw $1.2 trillion in the market. The Fed threw money at the market back in the days of the CV days, and that's a whole different scenario. The markets did well during that time. 22 was that was a real big move, mainly because all the meme stocks had everything crazy pumped up in 21. So 22 was a punishment year. And so 3 and 4, good years. still being books being cooked. Now we come into a different phase of economic development. Now you're looking at an old dude that was around when Ronald Reagan came out of the 25% range, and we started to see, we saw some crazy GDP numbers in 6 and 7% on a year over year. I mean, it was crazy numbers. So we're still looking at this capital investment phase. There's a whole nother phase coming out of where we have been from an economic standpoint of trying to see where this rotation is going to happen. And we know there's some knowns, and I always talk about this reverse fundamental. We know there's capital investments coming. Is it 1 trillion, 8 trillion? I couldn't tell you what's real there, but there is money that's going to come in to be invested. Now, maybe they're blowing smoke at Trump and he's buying into it, and we're all looking at it, trying to evaluate it. But at some stage, we'll know what the reality is as the announcements happen and who the players are. And I think that will be the second phase. I'm just flashing while I'm talking to you folks here is I'm thinking about the 2025 outlook that I did earlier this year. And I was reading it, just every once in a while I'll read it and say, where was I at? What were my thoughts going forward? A lot of things that I was talking about there have not occurred because of all this disruption and noise that we've had around the tariffs and those things. The evolution of the economy, though, as we go into 26, 27, I still think is going to be, AI is still going to be a really big multiplier of productivity. There's going to be a lot of things. Now we got potential capital investments, so we can stack up 26, 27, maybe out to 28. We can see the next phase of economics and what's going to happen, at least a vision of it, right? So we can start to anticipate that at some stage. The markets will start to anticipate that. I still, back to this is kind of I'm stuck in a loop a little bit here, but what I'm trying to say is the database on the intermediate will reflect when the next cycle is ready to go. And I've seen over the years, and this is where I think we are, but we'll pay attention to the numbers as they come out, is that we'll get these several starts and stops that are coming on. So right now, we've got a little bit of an increase. We'll see what kind of numbers we get out of this week's run when we run the weekly models. If we start to get a positive rotation, we get over 32 and certain things start to happen, then at that stage, we can start to extrapolate out some things at the moment. But for now, everything points to some sort of consolidation, and I'm still arguing, okay? It's May of this year. We printed a high. We're down 21%. Now we're down, 5-6%. So we've done that. Now, question is, do we retest those lows? What kind of information comes out, and where do we go from here? I just don't think we go to the moon, as some people will say, just because it seems like a fun thing to say. There's other elements that have to happen. I'm almost done with this riff here, is that you need that foundation that I've talked to you folks about, that the underlying, you need a number of stocks to be participating in the trends so that you can maintain, you have basically a foundation there to move along. And that's why 23 and 24 were successful, because we had a big foundation. And 24 was amazing because we stayed on the intermediate, but above 60% all year. We went 61 to 68%, which is very solid. It would not sell off. And if you go back, I was talking about that I thought we would see a top maybe in June, July, and then it got extended to September, October. Finally, as we come into this year, we finally got that to reset. And so we saw a complete liquidation of the database on a short term and some rebounds, a little bit of a rebound right now back to 70, but we haven't seen that rotation or that positive rotation happen in the weekly. So until this thing normalizes, we're not going to happen. I think I finally sunk the putt there. But this is important to understand because most people are just too busy looking at S&P charts going, oh, it's going to go here and go there. When you start to look at I think I have a very unique view of the world because I have this database that I'm showing you, because I understand the rotation, and I also understand because I built the models and all of the algos that are behind everything, and I've watched them work for three decades roughly. I think we officially brought this 1994. So we're looking at right at 30 years. So we've been through all the cycles, the craziness, the dot-com bust, the GFC, all of that stuff. We've been through a lot of rotation. And the original foundation of this product was built in 1994. So that there was a predecessor to even this. But the point is that I understand the rotation, and that rotation has helped from a macro view, and from intermediate to longer term view has given me insights over the years. And some of you I know have been customers or past customers over the last 20 years. And you know this to be valid here, especially 08, 09, and 10, all the way into 12. There was a lot of rotation that happened in this database. That was basically the bright light on that old country road I always tell you about. All right, so let's go on. What we're going to do here is for the rest of the show, we'll go through the S&P and what's setting up here. I'll show you the data sheets. Last night I forgot to do it, so I won't forget tonight. So let's go ahead and take a look at the S&P. So you can see it's interesting that the red dots are just flat lines. So we're looking at a complete flat line from the standpoint of what's being projected on a day-to-day basis. We look at the PPMs. We're seeing some basic liquidation there, where we're seeing momentum starting to bleed off. Looks like coming into the final week of this month is where we'll see some more momentum loss. But right now, all of the angle of attack is up. Let me just make sure I've got this link copied, and I'll bring this up so we can look at the data sheet. All right, here's the data sheet. And so we got 70%, but bullish consolidation phase. And that's exactly what we're seeing, just a flat line, just consolidating some of these gains that we've seen over the last couple of weeks. And then at the moment, when I did this sheet just a little bit ago, see we're down 850 now, so pretty valid from that standpoint. We have some it's detected a couple of divergences here. We're trading near the support levels, and as we look down here and we come to the PPMs, we're looking at everything. Look at this, PPM 1, 0.49, 0.40, and 0.07. But PPM 1 and 2 are in trend mode, and this is if I zoom out a little bit here, this is the market grid. So 59.27 has a 75% probability of being hit. And then we start to drop down at 59.50. I think we printed, I'll look at the number here in a minute, but I think we printed 59.80 just on that spike the other day. But this is basically 85% probability of 58.84. And I'm just looking up, hang on, sorry about that. Forgot I'm zoomed in. I want to just look up at the ranges here. So far, we've printed down to 92 low on the S&P, and the high's been 59.04. Let's just see what kind of trade setups coming up out of here. There's it's saying a support bounce. We're looking to buy S1, target 59.27, which would be R1. So it's looking at S1, R1 range. I think the volatility, if we come up here, by the way, I plan on later tonight, those of you that are on the Substack, and I put these in the Substack, you get the data sheets for S&P, NASDAQ, gold, and Bitcoin every night. I put out a quick start guide. I'm going to put out the full guide. I'm going to do it as a newsletter release. So if you're a subscriber, it will be out to free subscribers. So if you haven't subscribed, kendallreport.substack.com, you're going to get that full manual. I'm hoping to have that out tonight. I'm going to work on it this evening. And there's just some graphics I need to add to it, but it's in depth. There's trade setups, how to do all kinds of stuff with this. This data sheet's really powerful. There's a lot of things you can do, and I haven't done it yet, but I'll probably do a special video just on the data sheet and show you how to take this data sheet and put it in the Claude or ChatGPT and set up trades using the data from here. That's part of what's been programmed into this sheet down below. It's just working the market grid, but there's a whole lot of stuff with option strategies, straddles, all kinds of stuff. I've done a lot of this. I've tested it. So I'll put a video out once I get the manual. And then soon, I've got somebody, actually have somebody working on the project now from a programming standpoint to get this so we can get this sheet out to you folks and you can run it on any market of your choice. So that's coming as well. But anyway, you can get these sheets I put out every night, and then the manual will be out hopefully later tonight before. So it's going to look like two newsletters came out. I'm just doing it under the Kendall Report Substack. So there'll be special, here's the manual. I think I'm just going to throw it on Twitter too, so it'll be on a free version. Okay, enough of that. But this sheet's very powerful, and what's set up here is interesting. So I promise you we do something, right? So we're going to go back over to here, and let's set this up for a 4-hour chart. And I haven't run this, but let's just do it, because one of the things that you can do when you get your hands on this file, or on the ability to run different markets, is you're going to be able to put any increment of time. You can put a 5-minute chart in or whatever. You'll burn a lot of your tokens if you're using Claude, because two things are going to be required. You're going to have Claude, and you're going to have the indicators to be able to use this on any market. But that you can see on the 4-hour, this is interesting from a viewpoint of what's likely to happen here. As you can see, look at this, it's being projected that we're going to come down here to 57.85. That's kind of interesting, because that's exactly the market grid number we just talked about. So it does look like, that's 57, that was 58 that we were talking about. So the target right now, we've got, this is a 4-hour chart. We've got 3 fib targets on the downside. We also have this green line down here. Is it still valid? Yes, it is. So this green line is a major pivot, and that's setting at 57.40. We took that out, then that would signal a correction. But what's being forecasted right now is we're going to test this 21 and then ultimately the 40. This is the projections of the auto regression math that's saying this is what this chart's going to look like as we come into, we're looking at, this is quite I'm just looking here, Thursday. Yeah, so this is being projected into tomorrow for a potential correction. That would be a pretty big number. I think that's a little far out, but I think this 21 will be a better target, which is down at the 58, 59 level. And I just want to reference a couple of numbers I put out to you folks the other day, is that we're looking at, remember, 58.37. A lot of times you get those breakout points and those key levels. You'll come back to what I call the backside. You retest that 58.37 level, and then maybe get a bounce from there. But this is projecting some pretty good negative view. So let's do this, and I'm just going to take this, and I'm going to copy this. I'm going to over on my far monitor. I'm going to what I'm doing is I'm running this 4-hour chart. So we're going to run another 4-hour view of the data sheet and see what we come up with. So when that comes up, we'll go, and I'll just kind of move on. We'll move back, but this is key. You can see it looks like it's showing a decline into Friday's opening. So we'll see. We do get, by the way, PPI tomorrow. We get the employment stats to come out as well. So we're looking at the maybe some potential news that could move this market off the needle of the flat line that we've been on pretty much for a day or so, or maybe break some of what's happening here. So we'll see how this goes. I'm just waiting for this sheet to run. Okay. Yeah, it's just about completed, it looks like. It's just running some volatility and probability calculations. So we'll get an interesting snapshot here. So bear with me for just a minute. But yeah, so I know a lot of folks use the 4-hour chart, and this will give us a little view, and this chart, okay, it's run. This chart will be valid for the next, let's see here, what's left. Well, unfortunately, there's only hour 11 left in this 4-hour period. So it would be nice to run it right at the beginning of the next hour so you could have something. But anyway, this will give us some feel here. I'm just publishing this so I can bring it up on screen here. All right. All right, so this is the 4-hour sheet, and I'll break this down for you. As we're looking at 65% neutral consolidation, trading near key support, only one divergence. We're looking at targets S1, R1, even on here. I'll show you that here in a second. It's interesting because one of the Fibonacci projections that are on the screen right now is 90% to the target right now, which is at 58.99 target. So we're basically hitting that. We're looking at the PPMs here. This down here is the legend for this, and this would give me a plus T, which is an uptrend. And so PPM 2 is an uptrend, neutral on 3, neutral on PPM 200. And if we look at the probabilities here, 59.12 is 80%. And we were just looking at the daily sheet. So this is kind of an interesting viewpoint, is the daily sheets are suggesting that 59, I think 27, I'm going off memory here, are likely, but we get on this 4-hour chart, it's very, very low. There's a 80% probability for 59.12. We're trading 58.99 right now, so we're not really bouncing a lot. But it's also this was primarily just to show you what these sheets look like. So it's also giving us buying 58.99, get a 12 handle move, putting a stop at 92. So basically buying it right here, we're trading 59 even, and then trading up to that level. So just remember, this is for entertainment purposes only, right? So, but the reality is that that's the power of these sheets. You can set up and get some range, especially if you're an intraday trader. That's going to be really powerful. All right, moving on. Let's go to NASDAQ. We're still on a 4-hour. Let's stay here for a minute. So still, I think the 21 period moving average on the 4-hour chart is probably a pretty decent target. And that right now is at 29.79. So that's a decent little decline. And we're right at the 10 period moving average. If you remember the data sheet that we just looked at, it was telling us that that we were right on the support level, and this is now the NASDAQ, but the S&P was similar type configuration. So let's go over to the daily. So NASDAQ has, if we just look at the red dots, slight bias to the upside. This is daily. We still have this projection of this screaming 10-day moving average that is just coming straight up here. The dots are the projection of where this line's going to end up, and then it's not projected to stall until this is probably another week or so. So while I'm talking about the market stalling, we're going to go into the sideways range, and depending on what type of bars we get in the next day or so, if we did print down to those lower 58 handle numbers, and I mentioned 58.37, that would put us actually back for the NASDAQ. That would be a retest of 20,536 on the NAS. So that would be where you would look for a retracement back down, and I think that probably take multiple days. And I think this configuration that we're seeing right now on this chart will morph a little bit as we get more data. Some of the algos will start to adjust some of the angle of attacks in the future view. And I have this set on 50 days out, right? So that's going to be a bit different, but it's nice to have that perspective. And that's what I kind of can see, okay, that we're going to flow. Looks like a rolling effect that could, all of these numbers will adjust as we get actual data. We get today to finish, we come into Friday, and Thursday's down, and Friday we'll start to see some adjustments on that. As far as the algos go, same configuration as the S&P. As I said, these guys are cousins. They have the same family members. They have the top end of both indexes are weighted by the similar stocks. This has obviously a slant to the tech. Also has a little higher beta from an index standpoint. So that's why we're seeing a bit of upside from that standpoint. So this would be the best view, I think, as far as what to expect over the next couple of days. So there's still upward bias. I didn't run the data sheet, but it's going to look similar to the data sheet. It would be this one that we got on a daily, still 70% bullish, probably a 7 or 8, 10 trend strength, which is still very strong on the upside. So it's still buy the dips on this stuff. Just make sure you define your dips well. Don't get in too early, but I think the market grid range is going to be a pretty good deal. So those of you that have the indicators, you can just kind of reference those numbers inside the grid, and maybe even looking at that 4-hour chart. I kind of like when I was reviewing this earlier so we'll go from there. All right, let's move on. Where are we at here? 15 minutes to go. So let's dig into let's keep a watch on the 10-year. This is, I've talked about these fib targets that are up here. These green targets here, they're roughly here. I'll give you exact number: 483, 510, 527. The 483 is a retest of these highs that we got back in January. We had a little tantrum there, and I sold off the bonds pretty good. The what's looking like here, we still have upward bias on the PPMs in excess of zero point 0.4. It looks like maybe at the end of towards the end of next week we'll probably see some downward bias. So what's interesting about what's going on right now, the equities have a positive slope to them as we just went through, and we're still seeing the probability still pointing to rates continuing higher here. We're at 453. This last little high here was 459, so we're very close to breaking above that, and maybe heading to 483. And there's a number I've been telling you about for about a month or so, 4.72. We break that out, then we're probably going to see a 5% yield on the 10-year. So let's talk about that for a minute. How does that play out, and what does it mean to equity markets? So maybe if we did see that movement up, that would be the trigger for a deeper consolidation, maybe a move down in equities, and that would be the flow. But what we have right now, the setup is both of these markets, rates moving higher and the markets moving higher, still in a positive trend. So we're not seeing any of the trigger points right now, but I would suspect that if we do see this take out the 459 level, we start to head toward the 472, or we hit this first fib target. That will be an issue for the market at that stage. There's going to be some big questions to be asked from the standpoint of yields being that high, and that's probably going to put another notch on the downside in real estate. There's other things, and this is I can tie this together where we're talking about the treasuries. Is what's likely to happen here is that these effects of the economy is still, this back end yield is going to continue to have a drag on the economy, and like I said, I still see this ultimately getting us to negative quarter, maybe to as many as 3 as we come into year end and coming into 26. But like I said, Trump's got the ultimate play with bringing in some of these capital investments and using those to at least stabilize market sentiment. And he's a pretty good player from that standpoint. He knows when to pull the trigger. You think about it, he told everybody to buy that morning, right? And everybody was screaming at insider trading, all the craziness, but he told the world. So it's kind of hard when it was announced to the public. But the point is, he's a good player. He knows how to play this sentiment. He knows how to jack with the markets when they're starting to act funny. And I think that's going to be, I think the messaging that we've seen from the Trump administration is they're going to play those kind of games. They're going to manipulate the market sentiment that way. And as long as the numbers are stable, they're going to win on that. And so we have to be cognizant that those things could happen. All right, moving on. Let's go to gold. Gold's continuing to be under pressure. I've been talking about that. I think this area here ends up to be intermediate top for gold. I don't think there's a huge amount of downside, but we could end up running towards this 200-day moving average, which would put us down around 2790 or so. That number's rising a little bit, but we have some Fibonacci targets here. Right now we've got 31, 47, 30, 32, and 29.92. That's a downside. I think if we get there, we're going to challenge lows in this pattern here and ultimately roll to the 200. So there is some stability showing up on the indicators and the forecast, but this big one, the 40 and the 200 are really the driving forces. What we're looking at from the algos on the WTARs, which are predicting the moving averages, they're flatlining here right around 30, 32.90, right at that level. So we could, if we stay under this, we'll see these start to trend down, especially with some of the forecasts coming out. We'll see how that plays out from there. All right, let's go to Bitcoin. Bitcoin continues to consolidate here. If you recall, we got this. I'm just going to zero in on this a bit. We got this RTX sell signal. It's interesting. We've had two of these. We have another one over here during this run up, and we closed. And what an RTX sell signal is when it closes outside of that orange line, which is the extreme projected for the day. So we got that happen there. That tends to suggest at least 1 to 2 days sideways. In this case, it really was signaling the consolidation. And now we got another one, and we're getting a bit of a consolidation. But as we look at the forecast here, the red dots are saying we're going to follow this 10-period moving average. And this kind of comes to what I've been discussing for a while, is I still think this is we're looking at a historic moment in Bitcoin here from the standpoint, are we going to break over the 109, make an all-time new high? If we do, how does the market respond? Does it reject after that? Does it run? I've got a couple numbers above here, 113 and change, and then 121,000 and 136,000 are the big targets on the upside if we get a breakout here. If we get above 09, we print it, or we don't print it, the clock is kind of ticking a little bit on this breakout, but this formation still looks pretty decent from a configuration standpoint. So what we're likely to see is market stay above this projected 10-period moving average. Let's see what it's projecting. This is 110. So this little dotted line is saying we're heading toward the 109 plus breakout point. Then, like I said, I know I'm a broken record on this, but I've been emphasizing this every day. At that point, that's when we find out what the future is going to look like. And if we see a rejection of those numbers, we see the ETF managers and all the option folks and all the market makers around this, if they are able to we're going to find out what control they have in the market and what happens from that standpoint. If we reject, we get back under 105. That's a problem, but we need to make a new high. We got a little bit of a rejection the other day as we approach, I think, 105 and change. But now the big number is that 109. It's psychological high. If we break out and it runs and the stampede comes, that's awesome. If not, watch out for a rejection back under 105 initially and back under 100. I'm putting it out there because the volatility in this market, we could see a spike up and big rejection reversal. Okay, so we'll kind of close down. I'll look and see if there's any comments that I can respond to here real quick. Yeah, somebody's asking US JPY. That would be interesting. Maybe I can go into that. Yeah, so Descar live stream. Let me just look here. Yeah, okay, you're from Hammond, lived in Portage, really? In Portage most of my life. Shout out to the region, and it's the region, right? That's interesting. You should send me an email, info@Kendall Report. Yeah, I left Portage in 1981, a long time ago. Um, okay, I'm just looking here at some other comments. Um, yeah, that could be interesting. Somebody's commenting about the weekly jobless claims. They're around 235, I think, is the expected numbers. If that pushes up, maybe that'll be, maybe there's something there. That number's pretty stable. It has been. Just looking at a couple more comments, folks, and I'll come up with the. Yeah, Trump may pump Bitcoin as well. You may be right. And somebody sent me an email the other day, by the way, um, that the Fed was buying bonds, and that's an interesting scenario because they're supposed to be still doing the runoff on the bonds, right? So I haven't had a chance to look into that and validate that, but I did see some numbers. Somebody sent me an email. Maybe it was you that was pointing that out. So that is an interesting type of thing here. No, Andy, somebody's asking about, do you think that a new ATH are impossible? I don't think they're impossible, but I would expect if we did do something like that, we'd get a fairly decent rejection from there. So, well, we're there, folks. I ran about just right at an hour. I got a little bit late start, so thanks for showing up. Make sure before you leave, you hit the subscribe, hit the like button, do all that stuff, and then I will see you. Tomorrow will be the final broadcast for the week, so we'll set up the end of the week. So anyway, folks, thanks for watching. Appreciate it. We'll talk to you real soon.